You've got 100 grand sitting in your account and you're tired of watching it collect dust while inflation eats away at it. The big question is, which dividend ETF actually wins in 2025? SCHD, JEPI, or SPYI? SCHD is the classic, focusing on companies that grow dividends while rewarding patience over time. This ETF isn't trying to make you rich overnight. It's about bigger dividend checks in the long term. Then comes JEPI. It's a covered call ETF for immediate income, paying out chunky monthly dividends. Retirees love JEPI for its consistent cash flow. You get monthly payouts even though growth potential is capped. And then there's SPYI. It's making a lot of noise. It's an S&P 500 covered call ETF, like a hybrid of stability and income strategy. SPYI fine-tunes its option strategy to keep more upside while still delivering high monthly yields. It offers income without killing growth potential. Now, let's see how they perform. We'll start with a $100,000 investment in each one. With SCHD, you're looking at roughly a 3.7% dividend yield. That's about $3,700 a year in cash, which is around $308 a month. SCHD's strength is in future payouts, growing dividends year after year. In 5 years, that $3,700 could easily turn into over $7,000 a year if reinvesting. Your portfolio could grow close to $190,000 or even $200,000 depending on market performance. If you buy $100,000 of JEPI, you're looking at around an 8% yield or $8,000 a year in income. That's nearly $700 a month, steady and predictable cash flow. But JEPI doesn't grow as fast as SCHD. Over 5 years, that $100K might grow into around $180K. Not bad. The main allure is those dependable monthly checks. Next, there's SPYI, offering a yield around 11%. That's $11,000 a year or close to $960 monthly. While SPYI impresses with income, remember, part of that comes from options, not just dividends. If the performance continues, your $100K could grow to roughly $200K in 5 years, alongside serious cash flow. You've got 3 investment personalities: SCHD, the patient compounder, JEPI, the income machine, and SPYI, the hybrid with the highest yield. SCHD tends to hold up well during market corrections, dropping around 15%, but bouncing back quickly as people flock to quality. JEPI's covered call strategy helps cushion falls, limiting drawdowns to about 13%, acting like a shock absorber. SPYI is tied to the S&P 500, similar to JEPI, helping to reduce volatility, but its upside is capped in soaring markets. Regarding expenses, SCHD is a bargain at about 0.06%. JEPI costs around 0.35%, while SPY is pricier at about 0.68%. Tax efficiency is another hidden difference most people ignore. SCHD is simple: qualified dividends, easier tax treatment. JEPI and SPYI generate income from selling call options, which can be non-qualified or classified differently for tax purposes. It's advisable to keep JEPI or SPYI in tax-advantaged accounts like IRAs if possible. Income consistency matters too. SCHD pays quarterly, while JEPI and SPYI pay monthly, offering predictability. JEPI's monthly payouts can fluctuate, but are generally stable. SPYI's income is also monthly, but varies more. The best ETF for you depends on your financial needs. Do you need monthly income or long-term growth? If you're focused on growth, SCHD is your best friend, a compounding monster. If you want cash flow, consider JEPI. And if you want the high-yield adrenaline hit, SPYI is your pick. It gives you exposure to the S&P 500, pays huge income, and holds some growth potential. Just understand that higher yield always comes with more moving parts and a little more risk. Let's take those three ETFs, SCHD, JEPI, and SPYI, and drop them into real-world scenarios. Picture this. You put $100,000 into each one. Year 1, SCHD pays you about $3,700 in dividends. That's just over $300 a month. You reinvest them. Your portfolio compounds. And in 5 years, that $100,000 turns into something close to $190,000. That's SCHD's quiet power. It builds momentum like a snowball rolling downhill. Every year, the income stream gets heavier. That's why long-term investors love it. Investing $100K into JEPI changes the game. Instead of $300, expect monthly income around $680. The ETF sends checks monthly, thanks to its covered call strategy that turns market volatility into cash. While SCHD investors reinvest, JEPI investors collect. Both strategies are valid. It's about when to access your money. JEPI may grow more slowly, turning $100K into $180K in 5 years. But you've pocketed tens of thousands in income. Now, SPYI is the wild card. Investing $100K starts giving you nearly $960 a month, over $11,000 a year. SPYI tracks the S&P 500 and applies an option strategy to boost the yield. It's like having an extra salary. While total returns in a bull market may vary, the monthly distributions keep flowing, making it hard to complain. If performance holds, your balance could reach $200,000 in 5 years, all while enjoying ongoing income. SCHD is that reliable worker who shows up every day, never misses a shift, and keeps getting raises. JEPI is the contractor, gets paid more frequently, cash in hand, but doesn't always build as much long-term equity. SPYI is the freelancer who figured out how to make more in less time. Bigger checks, a little more chaos, but impressive when it works. SCHD's the clear champ on long-term dividend growth and low expenses. JEPI is the go-to for consistent monthly income with lower volatility. SPYI's the income king if you're chasing yield. They're like 3 tools in the same toolbox. You just have to know which job you're doing. During corrections, SCHD usually takes a hit, but it recovers because people rush back to dividend payers. JEPI cushions the fall. Even when stock prices drop, the premiums help offset losses. SPYI keeps income flowing while trimming downside risk. When the market rebounds, SCHD runs faster. JEPI and SPYI cap some of that rebound. SCHD barely charges you anything. $6 a year for every 10 grand invested. JEPI's a little higher, SPYI is pricier. But with 8 to 11% yields, a small fee is worth it. Now taxes matter. SCHD has qualified dividends, easier reporting, lower tax rates. JEPI and SPYI are trickier, with income that isn't strictly dividends. Some payments from JEPI and SPYI may be capital returns, lowering your cost basis. Most hold these in retirement accounts for simplicity. Lastly, consistency matters. SCHD pays quarterly and grows. JEPI and SPYI pay monthly, which is better for budgeting. SCHD growth is slower versus JEPI and SPYI's monthly payments, but predictability is a big factor in choosing them. Let's build some sample mixes. If you're younger, say in your 30s or 40s, and your goal is long-term growth with a side of income, SCHD should probably take the lead. Maybe 60% SCHD, 25% SPYR, 15% JEPI. Your portfolio keeps growing, but you still get monthly income. If you're middle-aged, balancing both growth and stability, then split the difference. Something like 40% SCHD, 40% JEPI, 20% SPYI. That gives you steady income without sacrificing compounding. You're earning solid cash every month while growing your capital. If you're retired or living off investments, your priorities flip completely. You want cash flow now. JEPI and SPYI become the stars. Maybe 50% JEPI, 30% SPYI, and 20% SCHD for a little growth anchor. You'll be earning over $700 to $900 a month per $100,000 invested. The downside? Less capital appreciation, but it's a trade worth making. Each of these setups has a different vibe. Align the ETF with where you are in life and what cash flow you need. The difference between these funds isn't just in yield percentages. It's in how they feel. SCHD is quiet and reliable. JEPI feels like a steady paycheck. SPYI feels like getting a performance bonus every month. Decide which emotional rhythm fits your lifestyle. If we're talking pure total return potential, SCHD is still the quiet powerhouse. It rewards patience with dividend growth and compounding. For real monthly deposits, JEPI takes the crown. Its consistent yield turns portfolios into paychecks. Retirees love it for its reliability. The trade-off? JEPI won't double your capital anytime soon. But that's okay if your goal is stability over spectacle. And then there's SPYI, the wild card that's surprising everyone. It's new, it's aggressive, and it's paying double-digit yields while still tracking the S&P 500. For investors who want to live off income but don't want to abandon growth entirely, SPYI offers a sweet middle ground. It's kind of like getting the thrill of JEPI's income with a little SCHD-like compounding sprinkled on top. The risk is, it hasn't been tested through a full market cycle yet, so while it's shining now, we'll have to see how it handles future volatility. CHT is the long-term builder, JEPI is the dependable paycheck generator, and SPYI is the bold newcomer shaking things up. 5 years down the road, assuming average market conditions, something interesting happens. SCHT's total value probably edges out the others, but its cash flow is smaller. JEPI lags a little in total growth, but you've already received so much in income that it evens out. SPYI sits in between, strong income and decent growth. In other words, you could build a seriously balanced portfolio using all three. Instead of betting everything on one ETF, you spread it out. 40% in SCHD, 35% in JEPI, and 25% in SPY. Suddenly, you've got this beautiful balance of growth and income, earning roughly $600 to $700 a month. SCHD keeps your wealth growing with dividend increases. JEPI provides dependable monthly checks. SPYI adds high yield and excitement. This trio checks every box, diversifying not just across sectors, but across income philosophies. The best ETF isn't the one that pays the most, but the one that fits your life stage. What makes this conversation so fun is that none of these funds are bad. They're all winners, just in different weight classes. SCHD is the marathon runner. JEPI's the endurance cyclist. SPYI is the sprinter. The smart move isn't to crown one king, but to learn what each brings to your portfolio. If you're wondering what to do with $10,000 or $100,000, ask yourself, do I want my money to grow quietly, or do I want it to pay loudly? SCHD is quiet wealth, JEPI is loud income, and SPYI is somewhere in the middle. Pick the one that feels right for you. Markets will change, yields will shift, but your strategy doesn't have to panic. Dividends are about time, not timing. If you found this helpful, don't just scroll away. Hit that subscribe button. Tap like and comment below telling me which team you're on. SCHD, JEPI, or SPYI. In 2025, income isn't just a number, it's a strategy. The smartest investors are already living off it.